We also have Shweta Daptardar from Elara Securities joining us to give us more details on the same. Shweta, firstly, to start off with this profit warning given by Fusion Microfinance, do you even expect the company to report profits in the second quarter? And how are you looking into this announcement and the impact on the other MFIs?
Yeah, hello, good afternoon. So the announcement comes as a little disappointment. However, we have been factoring in higher loan loss provisioning across the players in the microfinance space, given the kind of headwinds these players have been facing for a while. Look, we have to understand that the issue this time around is more structural. It is also because there have been increased regulatory oversight for the whole space per se, and that largely emanates from the fact that there has been over leveraging of the customer base for the MFI players. If you look at the past 1 year data of MOSPI, the rural economy, as far as the jobs as well as the income levels are concerned, they have either stagnated or remained steady at best. However, if you compare that with microfinance loans and the ticket sizes, they have increased disproportionately. That's point number one. Point number two, we have to also allude to the fact that there have been change in regulatory norms. So earlier, RBI had put a ceiling on lender, a number of lenders per borrower. Now the ceiling is on income assessment of the household incomes. However, if on the flip side, while this has been positive on reducing 90 DPD, but given the increased geographic challenges and higher ticket sizes, we have seen this leading to over leveraging and higher MFI loans in the system. And last but not the least, the geographic specific issues. So if you look at certain geographies, say Madhya Pradesh, Kerala, Rajasthan, Punjab. So Punjab, our channel checks indicate that the collections month on month are improving, but there are many geographies which are still remain over leveraged as far as the lenders are concerned. So coming back to the moot point, the fact remains that there are structural issues. We will continue to see higher credit cost across players. Fusion, particularly in question, has seen problems across key geographies, and the credit cost will further, like the press release that came over the weekend, clearly highlights closer to 60% increase quarter on quarter on the ECL provisioning requirement, which definitely would have a bearing on the profitability.
Which are those MFIs apart from Fusion Microfinance that one needs to worry about given the fact that credit cost is going to increase?
Yeah, so see, like I mentioned, I'll reiterate the problem is structural. FY25 is a little whitewash, especially emerging from the fact that the credit cost or the provisions will be higher across players. And if you look at the valuations, it is already definitely reflecting in the price to book multiple of most of these players. So we have seen sectoral derating that is happening because of such asset quality issues. We have Credac today stands at 2x multiple, whereas all the other players are trading below 1x. So while these valuations in the near term will continue to remain slightly on the weaker side, the problem is also because most of these players are recalibrating growth and as well as the pricing strategy. So the larger issue which RBI or the regulator is trying to address is the over indebtedness at the borrower level and evaluation of risk pricing strategy, whether these players are adequately pricing in risk. We at Elara had already foreseen these issues and
Sure.
recommended exit from microfinance space. But yeah, the problem would persist for another 2 quarters.
Understood. So a couple of quarters is going to be weak for microfinance, but I think earlier, Shweta, you had recommended to switch from MFIs to the affordable housing category as well as the gold financiers. Talk to me about what are your top picks within those two segments?
Yes, clearly, given the tight liquidity scenario at the end of banks, post the Fed rate cut announcements, which will pave way sooner for domestic interest rate downward cycle, this definitely bode well for two important sectors, and that's one is housing finance and gold financiers. Gold financiers definitely have been riding on the underlying price wave. and Muthoot Finance clearly remains the market leader. We have IIFL Finance now back in reckoning post the embargo lifting by the regulator. Manappuram Finance definitely looks stronger. So we like Muthoot Finance in the entire gold finance space. Coming to the affordable and housing finance, so clearly the real estate cycle is back in reckoning. Household savings are moving into real assets. We have developer balance sheets now sort of gaining grounds, and definitely inflation now coming in control. Affordable housing finance space is equally looking stronger. Moreover, the BHFL listing definitely sort of rubbed off positively on most of the players in the industry. We remain positive. So while the valuations have caught up really well, on relative basis, we definitely like Aadhar Housing Finance, we like Aavas, we like PNB Housing Finance in the space.
Okay, on that note, Shweta, we let you go. Thanks so much for joining us today to talk to us about the MFIs, affordable housing, as well as the gold loan category.
If you like this video, then like, share and subscribe to ET Now.